Okay, good afternoon everyone. Welcome to this second in our series of sort of 25 to 30 minute revision blasts for A-level business. My name's Jim, and you can see today I'm joined by Graham in the middle and Mike on the right. How are you doing, guys?
Very good, thanks, Jim.
Graham,
Good
if you want
afternoon,
to
everyone.
just give us an overview as to what to expect and how you want the students to use the chat window, and then when you're ready, I'll flick the switch and we'll get cracking with activities.
Yeah, hello everyone. Welcome back to more A-level business fun and frolic. So we've got 8 different types of activity for you to do today, about 20 questions. We would really like it if you could type your answers where applicable in the chat window, and we will monitor that and we can respond to any queries in there. There will be 3 calculations to complete. So if you could have a calculating implement, smartphone, calculator, that would be great. So we're going to kick off with some MCQs and then work our way through, finish off on a calculation, and then I'll advise on what our next live revision blast is. So shall we get started? Okay, first question. So we're going to take it nice and easy and then progressively get a little bit more challenging. So question 1, a downside of issuing shares to new investors is loss of some control, worsening cash flow position, dividends don't need to be paid, the amount is treated as debt. So all you need to do in the chat window is type in if you think it is. The answer is A, B, C, or D. Lots of answers coming through, which is great to see. Couple of more seconds on that. Quite straightforward one. Yeah, I think most people have got it. So let's, Jim, if we can have a look at the answer. Excellent, loss of some control. So a key concept you need to be familiar with is a concept of divorce of ownership and control, which is really prevalent in public limited companies. So that's something that can really add value to your exam answers if you can bring in that concept when you're looking at issuing shares to investors. So shares obviously dilutes the ownership of the company. So question 2, a business has a current ratio of 1.5 to 1. The business has current liabilities of £150,000. What are the current assets of the business? So you should know the formula for the current ratio, and all you have to do is rearrange it, and that will allow you to find out the answer. So a couple of seconds. A business has a current ratio of 1.5 to 1. The business has current liabilities of £150,000. What are the current assets of the business? A couple of more seconds. Now, I think I've only seeing a couple of people here. The majority has gone for B. And see, Will Spencer there's got C, and there's a few other C's coming in, but the majority has gone for B. Let's find out what the answer is. The answer is C, 225,000. Now remember the formula, and you won't be given the formulas in your exam. The formula for current ratio is current assets divided by current liabilities. We know the current liabilities are £150,000, so we can reverse the formula. 150,000 multiplied by 1.5 will give you the current assets of £225,000. And you can work that out by dividing 225,000 by 150,000. That would be your check, and that will give you 1.5 to 1. Now, it is really, really important in all calculation questions to show you're working out. That way, even if you got the final answer wrong, the examiner can award some marks, or whoever's assessing your work can award some marks if they can see some evidence of understanding. Good stuff, and I'm glad to see that it makes sense now. So quite straightforward one here. Which of these is usually a variable cost? Is it a loan repayment, rent, insurance, or packaging? So which of these? If you can type your answer in the chat window. Don't think it's F for some reason. I don't know why that is, but I don't think it's F. Is it A, B, C, or D? Yes, we know our variable cost. Now, remember, a variable cost is a cost that changes in relation to output or sales. Even a loan repayment on a variable interest rate is not linked to sales or output. So we still class that as a fixed cost because it's not related to output. So packaging is the correct answer. Excellent work, team business. Fantastic. Let's move on to another one. Now, take your time with these. These are two statement questions. So you've got two statements there, statement 1 and statement 2. All you need to decide is whether statement 1 is true or false and whether statement 2 is true or false. So have a read through both statements and select whether you think the answer is A, B, C, or D. So a favorable cost variance occurs when budgeted fixed costs are lower than actual fixed costs. Is that true or false? Statement 2, a favorable profit variance occurs when actual profit is lower than budgeted profit. What do we think? Can we put our answers in the chat window? So I think we can see here, you know, a lot of variations in the answer. They seem to be straddled between really people selecting them all. Let's have a quick look at the answer. The answer is D. So a favorable cost variance occurs when budgeted fixed costs are lower than actual. What that's saying is that actually actual fixed costs are more than budgeted costs. And because the actual fixed costs are more than budgeted, it's an adverse variance, so that's false. And because actual profit is lower than budget, then that's also an adverse variance. So just something to be mindful of. And that was similar to an MCQ from one of the exam boards that was asked in an exam paper, and that caused students a lot of confusion. So just make sure you are on top of budget and variance analysis. Okay, fantastic. Last MCQ from me before I hand you over to Mike. So it's two statements again. Statement 1, the formula to calculate break-even is fixed costs divided by contribution per unit. Statement 2, an increase in contribution per unit will lead to an increase in the break-even point, assuming all other variables remain unchanged. So have a read through those two statements and decide whether you think the answer is A, B, C, or D. So what do we think? Lots of answers are flying in. And I think a couple of more seconds there. I think the majority are going for B. Let's have a look at what the answer is. It is B. So the formula to calculate break-even is fixed costs divided by contribution per unit. Now, an increase in contribution per unit would actually lead to a decrease in the break-even point. Therefore, A is true, B is false. Thanks for getting involved, Matt. I'm now going to hand you over to Mike, who's going to take you through the next activity.
Thank you, Graham, and good afternoon, everyone. We're going to do the bubble quiz, and the bubble quiz is similar to the MCQs you've just done in that you're going to see a question and 4 possible answers. The difference here is that all of those answers could be correct, or indeed none of them could be correct, or anywhere in between. So what you're looking to give me here is a number, the number of correct answers to the questions that follow: 0, 1, 2, 3, or 4. If you want to be extra clever, you can put in the chat window the letters of the answers you think are correct. Let's have a look at the first of these then. So which of these are liquidity ratios? Which of these are liquidity ratios? Profit for the year or net profit margin, current ratio, gross profit margin, or operating profit margin? Which of these are liquidity ratios? Pop your answers in the chat, please. As I say, if you want to be extra clever, try and tell us which letters you think are correct. And remember, could be that they're all correct, or none of them, or anywhere in between. Thank you for the answers that I've had so far. Mostly in agreement. So which of these are liquidity ratios? The answer is that one of them is a liquidity ratio. The current ratio is a liquidity ratio, current ratio measuring current assets against current liabilities, calculated by current assets divided by current liabilities. And it's going to show how easily the business can raise cash to pay day-to-day expenses. The other ratios shown there are all profitability ratios, as given away by the word profit in them. Okay, so the current ratio is the only liquidity ratio. Let's try another bubble quiz. Which of the following would lead to an increase in contribution per unit? Which of the following would lead to an increase in contribution per unit? A, an increase in the selling price per unit. B, a reduction in fixed costs. C, an increase in fixed costs. Or D, a reduction in variable costs per unit. Which of those, if any, would lead to an increase in contribution per unit? Answers in the chat, please. Add some letters in there if you're feeling confident. Good, lots of answers. Again, some disagreement as to which of these will lead to an increase. A couple more seconds. Good stuff. Well done, all those taking part. Remember here that if you give it a go and you don't quite get the right answer, or you don't get all of the correct answers, that's not an issue. What we need to do is treat this as a learning experience. So the answer to this one, which of these would lead to an increase in contribution per unit? A and D. Well done, all those that got that right. So an increase in the selling price per unit. Remember that contribution per unit, selling price minus variable cost per unit. So increasing the selling price per unit and or decreasing the variable cost per unit will lead to an increase in contribution per unit. Always good. Graham, I think, said before that you're not going to be given the formulae in exams, so you need to learn these. And when you see a term like contribution per unit, if you can remember the formula for calculating contribution per unit, it will help to answer questions such as this. A and D were the correct answers here. That concludes the bubble quiz. Let me hand you back to Graham for the next activity.
Hello. So this is a very quick activity, 60 seconds to be precise. The clues in the title, 60-second challenge. So down the left, you have some key terms, and on the right, you have some definitions and formula. All you need to do is match them up. So, for example, if you think the current ratio is non-current liabilities plus total equity, then you can type in the chat window A1. So all you need to do is match the letter with the number. 60 seconds. Great stuff. Great to see so many answers. I think Carl said there that this was his favourite song, and I agree. It's one sick beat, that's for sure. So, can we have a quick look at the answers? If you can click on the next slide, fantastic. So, A4, current ratio. We've done the current ratio a couple of times now. B3, margin of safety. Actual level of output minus break even level of output. Variance is our actual amount minus budgeted amount. Capital employed, I just wanted to spend basically a minute on capital employed. Now, you may not have covered gearing yet, you may have, but you need capital employed in order to calculate the return on capital employed and also the gearing ratio. Now, sometimes you will be given the capital employed, sometimes you have to work it out. So it is really crucial you know that capital employed is non-current liabilities plus total equity, because that will allow you, therefore, to confidently calculate the return on capital employed and the gearing ratio should you need to do so. And sales revenue minus cost of sales is, of course, gross profit. Fantastic. So I'm going to hand you over to Mike now, who's going to talk you through a little calculation.
Thanks again, Graham. So we're going to do a variation of the 60-second challenge. Here's a calculation on the screen for you. And as the name suggests, you are going to have 60 seconds in which to solve it. So below is the budgeted and actual income and expenditure for a business last year. Calculate the profit variance and state whether it is adverse or favorable. You're going to have 60 seconds to do this. Good luck. And there we go. That's 60 seconds up. Now, remember, 60 seconds to carry out the calculation is actually very quick. If you can do this inside of 1 minute, if you can do it in 60 seconds, you're doing extremely well. Don't worry if you need a little bit longer. I've seen lots of answers flooding in and lots of correct answers flooding in. Always some confusion, or often some confusion around calculating variances. Remember, we can have expenditure budgets, we can have income budgets, and we can have profit budgets. And whether a variance is adverse or favorable varies slightly between the type of budget we're talking about. In this case, the budgeted profit is £80,000. The budgeted income, £140,000, budgeted expenditure, £60,000. So the budgeted profit is the difference between those, £80,000. The actual profit, again, difference between income and expenditure, 150,000 minus 50,000. So the actual profit is £100,000. So the variance is the difference between those. Difference between 100,000 and 80,000 is 20,000. Because the actual profit is higher than the budgeted profit, the variance is favorable. Okay, the variance is favorable. If the actual profit had been £20,000 lower than the budgeted profit, it would have been adverse, but this is favorable. Okay, £20,000 favorable. Well done. I'll hand you back to Graham for the next activity.
Cheers, Mike. So just 3 true or false questions here. A bit of light relief after those calcs. So true or false, can you type in a T or an F in the chat window, or you can type in true or false. It's up to you. True or false, a fixed cost never changes. Is that true or is that false? So a couple of seconds, a fixed cost never changes. Is that true or is that false? So there's a lot of people saying true, and there's also a lot of people saying false. It's definitely one of those two. Let's look at the answer, and the answer is, it is of course false. Fixed costs do change, but they just do not change in relation to output or sales. So the rent of a business might increase, but that is not in proportion or in relation to output or sales. So that was false. Next question. Venture capital sometimes results in a loss of control. Is that true or is that false? What do we think? Venture capital sometimes results in a loss of control. Is that true or is that false? So I think very quickly there, the majority have gone for true. Let's see what the answer is. It is indeed true. Sometimes venture capitalists are willing to invest large amounts of money into high-risk businesses, but often in return for part of the business. Okay. Next one. The formula to calculate return on capital employed is operating profit divided by capital employed. Is that true or is that false? Now, remember, Mike said earlier, and I've also said it as well, that you really need to know your formulas. You will not be given them in any assessments, so make sure you know them because they are really important. So the formula to calculate return on capital employed is operating profit divided by capital employed. Is that true or false? I think the majority have gone for false. Let's have a look at the answer. It is false because you would need to multiply by 100. Remember, this ratio is expressed as a percentage. So that is indeed false. Okay, I'm going to hand you back over to Mike, who's going to do another 60-second challenge.
Indeed, I am, Graham. And this 60-second challenge, another calculation for you. Last year, a business had yearly fixed costs of £180,000. The selling price per unit was £5, and the variable cost per unit was 2/5 of the selling price. We're tasked with calculating the monthly break-even point last year. Please take care, read the question. 60 seconds on this one, maybe a few seconds longer. Here we go. "60 seconds goes by quickly, and lots of answers coming in. Freddie, I think, was the first one I saw with the correct answer. The question, remember, has given us yearly fixed costs. We've got the selling price, we've got the variable cost per unit. You'll remember the formula for calculating break-even is fixed costs divided by contribution per unit. The contribution per unit is the selling price minus the variable cost per unit. So £5 minus £2. £2 is 2/5 of the selling price. So the contribution per unit is £3. Therefore, the yearly break-even, as many of you calculated correctly, is 180,000 divided by 3, which is 60,000 units. However, the question asks for you to calculate the monthly break-even point last year. So we take that annual break-even point of 60,000 and we divide it by 12, because there are 12 months in the year, and therefore the monthly break-even point is 5,000 units. Can we note here that when we talk about the break-even output or the break-even point, we're talking about a number of units. We're not talking about amount of money. So it's not £5,000, it's 5,000 units. Well done, all those of you that got that right. Back to you, Graham.
Yeah, fantastic. Well done, Mike. Thanks for that. So, red herring, you're going to be showing 4 items, 4 statements. All you need to decide is which is the odd one out and why. So, Jim, can we have a look at our 4 elements here, our 4 statements? So, A, B, C, or D, which of the 4 items is the odd one out and why? If you could maybe type A, B, C, or D, not all of those, just one of them, which is the odd one out and why is it the odd one out? Think carefully. Or, of course, you can type in the entire answer. Is it inventory? Is it receivables? Cash? Or payables? Lots of answers coming through. Now, let's have a look at what the answer is. Payables, indeed, the others are current assets. Well done if you spotted that. Payables is classed as a current liability. And it is really important to know this in case you have to go on to calculate the current ratio, or if you're an EdXL student, calculate the asset test ratio. So you might not be given total current assets and total current liabilities. You might have to work them out for yourselves using the terminology on screen. So make sure, and it's receivables and payables, where a lot of students do get confused between the two, whether one is an asset or a liability. Remember, receivables, receiving cash, payables, paying it out. So that's an easy way. That's how I remember it. Next one, venture capital, loan, overdraft, retained profit. Which of the 4 items is the odd one out and why? Is it A? Is it B? Is it C? Or is it D? What do we think? Is it A, B, C, or D? Lots of answers coming through now in the chat window, which is great to see. And let's have a look at the answer, Jim, please. It's retained profit. Well spotted. The others are all external methods of finance. Retained profit is an internal method of finance. Well done. So I'm going to hand you over to Mike now, who's going to take you through the last activity.
Thanks, Graham. And it's another 60-second challenge, another calculation. I don't think I need to introduce this. You know what to do. So we've got a table that shows the costs relating to a product, and the task is to calculate the total variable costs of producing 4 products. Total variable costs producing 4 products. 60 seconds. Here we go. There we go. And lots of answers and lots of correct answers here. So well done. The correct answer here is £80. In order to answer this, we need to know that total costs are fixed costs plus variable costs. We need to know that fixed costs are payable regardless of output, or they're not affected by output. In this case, if we look at 0 units of output, the total costs are 50. That must mean that fixed costs are £50. So at 4 units of output, total costs of 130 minus the £50 fixed costs means that the total variable costs will be £80. There's always a knowledge gatekeeper. There's always a formula to start from here. And if you know that, you should be able to access and answer every question. So that's the 60-second challenge done. Graham?
And there we have it. So that is the end of our A-level business finance blast, and I hope you found it useful. The levels of response was absolutely superb in the chat window. Amazing answers, and it was really, really good to see. Moving forward, we have our next one on the 9th of February, and that is going to be human resources with Mike, myself, and Jim again. Don't forget to hit the subscribe button so you will get an alert when that's announced. And just to say, on behalf of Mike, Jim, and I, thank you very much for getting involved. It's been superb. Thank you very much, and see you next week.
Yeah.
Thank you,
Cheers,
everyone. Thank you.